So, good morning, active traders. Welcome to our Trading Week Ahead broadcast for today, Saturday, the 16th. Hopefully, everyone got their taxes all in on time and the day after tax day. Now, speaking of taxing, we've got a long weekend, right? Friday, we were off. A happy Easter, everybody. I wanted to wish you all the best for a happy Easter weekend to you and your loved ones. We've got an exciting week ahead coming up in our markets. Markets have been going down lately, right? You remember that one of the key concepts that I like to trade off of myself is large green candles. Hint, what color are most of the big candles this last 2 weeks? Is it A, green, or is it blue, or is it B, red? Obviously, the largest of the candles, the biggest range candles, wide range candles are red in a downtrend, and we closed under under all three major moving averages, under the red 50 SMA as well as the yellow and blue 100 and 200 SMA. So we're in a downtrend. So does it make sense to get out there and buy stocks because people on Talking Head Television are saying, well, there's quality oversold and there's some really good deals out there? No, epic fail. I'm not going to be buying anything equities related unless the market takes out all-time new highs or if we pivot off the 4,100 low. But for now, it's a seller's likely to keep going down market. But anything's possible, right? That's what keeps us on our toes. Large red candle day there. Now I bet kind of heavy on UVXY on Thursday going in. I think I'm in just over 700 shares, which is a big position size for me in this. That's maybe, apologize the dogs. Anyway, it's at support. And so UVXY is at support. If we take a look at our VIX, one of the things you'll see is that our VIX has recovered above the 20, and it stayed above the 20 for the entire last week and a half. That did not escape the notice of Wall Street's smartest quantitative analysts, right? Remember, we used both the S&P Spiders chart as well as the VIX with each other in tandem, and so you can see the VIX is holding above the 21. As long as the VIX, as long as the VIX, hey Ari, well, good luck, man. I only did 700. I thought that was heavy. We could be wrong. It could flip down. 11.12 or 11.2 or so is the 52-week low. So that's the maximum pain point. If it doesn't work out and it gaps down, scale out on the way down there. Be all out by 11.10 is what I'm going to do. But we'll see. We'll see. It's a VIX is remember the VIX is guaranteed to go back up. It's not a matter of if, but when. Our CBOE volatility index is always an up and down mover by definition. It's how it works. Hey, Greg. If you got a question, just type it in chat and I'll answer every single question that I can. So the VIX is always up and down, like the letter W. Sorry about the dog in the background. I can't do anything about it right now. She, much like the stock market, if I tell the dog to do something, she doesn't listen. So that's okay. Dogs are stubborn, as are some people. Anyway, our VIX, remember, 21 or so support, 30 is what the street usually uses as a major resistance, so it's not really any evident there. Technically, our resistance is up in the 30s. Now, when it comes to, wow, 282, the 10 years at 280, yeah. Yeah, bond yields are spiking. We've got interest, inflation through the roof. Remember, if you do trade volatility instruments like UVXY or the former VXX or other ones, remember to sell into the spike, right? You buy low, you sell high. Tighten in trailing stops on the way up because that's how I got out with 940 on my TVIX sell, right? Those biggest multi-$100 per share win I've ever got in my life. So remember, when you get a VIX spike like this, sell into the rollover, and you buy on the way up, right? You buy into the pivot. It goes down, you buy the bounce, buy low, sell high on the rollover. So, and do that in increments, right? So, again, I apologize, the noisy little dog out there. Anyway, keep an eye on the VIX. As long as the VIX stays over 20, we should have a moderately bearish bias in the market, right? If we get down here, it may be more bullish territory, but as long as we stay above that 200 SMA, which is right near 21, I'm using 20, 21, as long as the VIX stays above that, you should have a short bias in the market. And for those of you options traders, you might want to buy index puts, or whether the weeklies or even dailies. And for those of us who are equity and ETF traders, we either want to intraday short or swing trade inverse instruments. Now, small caps and technology often lead the other markets up and down. And so far, you can see technology has been weak lately with our NASDAQ and its high valuation stocks taking it in the chin and going down, and therefore our SQs has been going up. You can see TQs is going down. So they trade opposite of one another. That's one thing that I want to encourage you to think about is what I call pair trading. Whether you're swing trading or day trading, as one goes up, the other is guaranteed to go down. There's a way to leverage that. And that's one thing that I want you to give some thought to for how to trade in the current markets. Technology, technology, banking, and small caps in our current market are the three lead weak indicators. So if we see weakness and continued weakness in our NASDAQ, the SQs will continue to climb up. It was $50 a share just a few weeks ago. Now it's bounced off 30 and did a really nice pivot to the upside here. So do keep an eye on that. Now, if we take a look at oil and oil-related stocks, oil and energy continue to be relatively strong. So you can see Occidental Petroleum, Halliburton, really good chart. ConocoPhillips and others are up. If we look at some of the other charts, like MOS, they also continue on up. So there are charts that go up in spite of a down market, but I would urge you to follow the major trend of the market. And so as the market's going down, at least I'm trying to figure out how to make as much money as possible if that weakness continues, which it is widely expected to do. If we look at some of our tech names, you can see Apple's been down off the previous highs, as has been Tesla and others. Now, if we take a look at some of the other, like healthcare and pharmaceuticals, things like Eli Lilly up nicely, but we had a shooting star here, right? And never did pierce the shooting star, and it generated a sell signal here. You can learn more from my colleague Steve Nissen at candlecharts.com on candle charts, but does everyone see why where I'm pointing would be the place to have sold LLY? Because we had a shooting star, it put in the top, you're supposed to sell under the candle of a shooting star and lost that for a swing trade. So you sell down there, and that's exactly what happened here. You buy on a high, say bullish engulfing or above a hammer or above a bullish engulfing. Let's see, that actually would have stopped out. So that hammer signal wouldn't have worked. But that's rare. We got a nice bullish engulfing that would have saved the day and took it up to nice. Shooting star, multi-week consolidation, another breakout shooting star, and it's sold. We've got a Shih Tzu that's all of 12 pounds dripping wet, and she's noisy. I apologize for that. Anyway, ADM also looks good. Now, again, we don't buy nines. So, for example, if I were considering, I don't trade things that are $100 a share, but if I were, I'd wait for it to get over the 100, like over 102 or so. You sell into the areas that other people are selling. And professionals are always selling into decade or other obvious areas, so you don't want to be a buyer of something that may well get sold off soon. Walmart's looking good. Costco's good. Kroger's good. And more. So to recap, broad market, I'd use 4360 support and the 44, even 4500 resistance, because that's the 200, right? So we had the death cross here. The market said fake out, and it came right back down. One thing I want you to pay attention to the next week or so is the height and the color of the daily candles in your S&P. Are they small, indecisive doji type candles, or are they large, printing green or red in a defined trend? We obviously have a relatively strong downtrend here, and if you take a look here, you can see now one thing to note is how far does it trend down before it pivots? How far do the waves down go? And what you'll find, the more you trade, the more you identify specific price action length of runs or length of a trend, how far does it go usually before it slows down and reverses back up? The reason that's of importance is because that's what other traders use, right? That's what professionals use. We're looking at length of trends, we're looking at flips and volatility with the VIX, and we're looking at where the next big trade's going to be, right? So again, the main point here is we lost all three major moving averages, both on Tuesday. It held there on Wednesday and closed at the week's low on Thursday. So I went short the market. I'm in mostly UVXY, but also some SQs and other instruments. Bond inverse TBT, interesting. I have not traded that. That's a good chart, thanks. I'd hit that. TWT, TBT, that's the bond inverse. Hey, Polly. Polly has a couple of charts for us. If you guys have charts, hit me up and I'll see what, yeah, that's great. That's a good chart. That's one of my favorite patterns is a small followed by a large green candle up at a new high. So that's good over, and it broke the 30, the decade value. So that's really good. Not a trading recommendation, but I would hit that at 31.7. And yeah, that's a good chart with a hard stop at 30. Remember I said that, 31.7 long, hard stop at 30. Scale in every $2 or so. Exit target would be the high 30s, like 38, maybe 39. Let's see, Exxon. I don't particularly care for that chart because it's kind of haphazard. If we look for a target on that, if we look on the 6 month, the main thing to identify is the box range depth, the box range height. And so, for example, if we look at this, and I apologize for the annoyingly noisy little dog out there. You extrapolate from the box range and flip it up, like Darvas boxes. I highly recommend everybody read How I Made $2 Million in the Stock Market by Nicholas Darvas back in the 50s or whatever or 60s. Anyway, so depth of that 16 points, so 16-point extension run would, best case, maybe 106, right? I'm sorry, 90, 100, 74, 84, 94. 16 points. So 16 plus that is 106. So exit target would be in the low 100s, like 104 to 106. So whenever you want to extrapolate a target or you want to figure out, it's all based on price elasticity and ranges. So the range there, and again, that's no guarantee or anything, but that would be where I would be tightening up a trailing stop and feeling happy about it if it ran up as far in the next box up as the first box. And that's all we've got. I mean, that's not rocket science and there's no guarantees or anything, but that's the best case. That's what most of the Wall Street guys use. The quantitative analysts use the box range price extensions to map out an exit target. Where that comes in helpful, more so than just having some arbitrary exit target, is position sizing, so you know not to add to a trade if it does keep running up to that box range edge. See a trader asking about SWX. Yeah, it's a good chart. That was weird. It blanked out. Can everybody still see the image? I don't know why it blanked out.